Welcome to the deep dive. Today we're taking a long, hard look at a name that really embodies the entire arc of 20th and 21st century global finance.
American International Group, Inc.
AIG. And this isn't just, the story of an insurance company.
Not at all.
It's a century-long saga of ambition, of unchecked expansion, catastrophic failure, and then a government rescue so unprecedented it basically reshaped global regulation.
When you look through the sources for this deep dive, the sheer scale of AIG today is it's immediately apparent.
Right.
We're talking about a multinational finance and insurance giant that operates in over 80 countries and jurisdictions.
80. That's incredible.
And the level of integration into the global economy, I think, is captured by this one fact. AIG serves 87% of the Fortune Global 500 companies.
So it's not a stretch to say it's a critical artery of worldwide commerce.
It truly is.
Exactly. AIG became less of a company and more of, I guess, an economic ecosystem. So our mission today is to follow that entire evolutionary path. We're going to start from its most unlikely birthplace. Then we'll go through its transformation into a financial titan, its spectacular near collapse in 2008, the massive government intervention that followed, and then, the painful but ultimately profitable recovery that culminated years later.
And before we jump back a century, I think it's worth grounding ourselves in what AIG is right now.
Good idea.
So in 2024, they operate primarily from their headquarters in New York City, 1271 Avenue of the Americas. They're structured around two clear pillars: general insurance, that's global commercial and personal lines,
Okay.
and life and retirement, which focuses on group, individual, and institutional markets. And they also have a standalone tech-enabled subsidiary.
And despite the decade of, dismantling they went through, they remain financially colossal.
Oh, absolutely.
Yeah.
As of 2024, the company's reporting total assets of $161.3 billion and a workforce of about 22,000 employees.
But for anyone tracking modern finance, AIG will forever be defined by one specific moment in time.
That defining moment is, without doubt, the 2008 financial crisis. I mean, AIG became the symbol of too big to fail.
The poster child.
Exactly. It received the largest government bailout of a private company in U.S. history. The initial credit facility from the New York Fed was authorized up to $85 billion.
And it just ballooned from there.
It ballooned to a total commitment of around $180 billion. That single figure really defined the crisis.
But here is the incredible twist. And this is the part of the narrative that so often gets simplified or just forgotten. AIG didn't just take the money and vanish. They completed what has to be the ultimate turnaround. By 2012, AIG had repaid a grand total of $205 billion to the U.S. government,
which resulted in an astonishing positive return, a profit of $22.7 billion for the U.S. Treasury and the New York Fed combined.
So the government, acting as the lender of last resort, not only stabilized a critical institution, but actually made a profit for the taxpayer.
That remarkable outcome is just crucial context for understanding the high-stakes decisions that were made back then.
Okay, so that sets the stage for a pretty dramatic history. Let's start at the very beginning. Section 1, the global foundation and initial growth from 1919 to 1979. And we have to start with AIG's roots, which are geographically fascinating.
Yeah, we're starting very far from Wall Street. The American International Group was founded in Shanghai, China on December 19th, 1919.
That's the ultimate aha moment in this story, isn't it? The company that would later be rescued by the U.S. Federal Reserve began as a foreign enterprise in a developing market.
It's incredible.
So the founder was an American, Cornelius van der Star. What drove an American entrepreneur to set up shop in China at that time?
Well, Starr was a visionary. He recognized the tremendous potential of these rapidly modernizing yet completely uninsured Asian markets. So he established his agency, originally called American Asiatic Underwriters, or AAU.
AAU.
He saw that traditional Western insurance models just hadn't penetrated these regions yet. It was a blue ocean opportunity.
And I guess the expansion was rapid, which must have confirmed his instincts about the demand.
Absolutely. The AAU quickly expanded branches all throughout China and then into Southeast Asia key hubs like the Philippines, Indonesia, and Malaysia.
So this established AIG's core philosophy from day one. It was a global enterprise first, tailored to local needs rather than just a U.S. company exporting its services.
That global DNA is absolutely key to understanding its eventual complexity and its eventual risk.
Right, so while the focus was initially on Asia, Starr wisely recognized he needed a U.S. foothold.
He did. In 1926, he opened the first American office, the American International Underwriters Corporation, or AIU.
And the AIU was crucial because
It was crucial because it allowed Starr to service the increasing number of U.S. and multinational businesses that had operations over in Asia. And then, as political volatility started to rise in the Far East leading up to World War II, Starr made a critical preemptive move.
he started focusing on Latin America.
Exactly. It was an early lesson in geopolitical risk management.
It sounds like proactive hedging, really.
It was. By the late 1930s, AIU had established significant operations, including an office in Havana, Cuba. And that steady growth in Latin America proved essential. It helped to offset the decline and eventual shutdown of business in parts of Asia as the war intensified.
So by 1939, he makes the decisive move and relocates headquarters from Shanghai to New York City.
And that solidified AIG's status as a multinational entity, but now based in the U.S.
After the war, the global military presence of the United States must have provided a whole new path for AIG's growth.
A very lucrative one. AIU leveraged its American association to get into occupied territories like Japan and Germany right after World War II.
And what were they selling there?
Primarily providing life and general insurance products for American military personnel. This is a really strategic entry point that quickly paved the way for providing coverage to local civilian populations and, the rebuilding economies.
And this European expansion really solidified AIG's international footprint further into the late 40s and 50s.
Yeah, we see rapid growth into France, Italy, and the United Kingdom. Meanwhile, Starr was also integrating the domestic American side of the business, which was still lagging a bit behind the international network.
Right.
So in 1952, he acquired Globen-Rutgers Fire Insurance Company and its subsidiary, American Home Fire Assurance Company. By the close of the decade, the CV Starr organization was a true global behemoth.
Covering general and life insurance across more than 75 countries.
75 countries. It's an incredible reach.
So now we get to the internal revolution. Reorganization and the rise of Greenberg from 1959 to 79. This is where the company shifts from Starr's sort of entrepreneurial vision to a tightly managed, modern corporate structure.
And the key personnel decision was CV Starr hiring Maurice R. Greenberg, universally known as Hank Greenberg, in 1960.
Right.
He was initially tasked with developing an international accident and health business, but his impact, as we'll see, went far, far beyond that.
The sources credit Greenberg with implementing a genuinely revolutionary strategic shift in the U.S. market. Can you tell us about that move away from salaried agents?
Greenberg fundamentally reorganized one of Starr's U.S. holding companies into a successful multiple-line carrier by focusing entirely on selling insurance through independent brokers instead of salaried agents.
And that was a radical departure for a major insurer at the time.
Completely radical.
So why was that business model so critical? What was the advantage?
Well, it was a game changer primarily because of cost control and risk management. By using independent brokers, AIG essentially shifted the cost of sales, salaries, offices, benefits onto the broker.
Which dramatically lowered AIG's fixed overhead.
Exactly. And crucially, it gave AIG immense pricing flexibility and discipline. If a line of insurance became unprofitable, AIG could just jack up the price.
And the brokers would either have to absorb the reduced commissions or just find another carrier.
That's it. AIG wasn't burdened by high fixed costs, which meant they could afford to sit out competitive markets and wait until the pricing was right, without fearing these massive quarterly losses from carrying an expensive sales force.
And that aggressive focus on underwriting discipline and tight operational control became Greenberg's enduring signature.
It defined the company for decades.
This level of expansion, it must have demanded a unified corporate identity?
It did. By 1967, American International Group, Inc., AIG, was incorporated as the overarching umbrella organization for most of Starr's diverse insurance businesses. Starr named Greenberg his successor in 1968, marking the transfer of power.
And then AIG went public the following year in 1969.
Right.
The 1970s brought back those geopolitical headwinds that Starr had faced decades earlier, though.
That global reach had its downside. AIG was forced to curtail or even cease operations in several volatile regions across the Middle East and Southeast Asia because of changing political dynamics and nationalization efforts.
But true to form, AIG used its specialization to find new markets. How did they pivot this time?
They specialized in niche products that very few other insurers could handle on a global scale. Things like complex energy infrastructure coverage, large-scale transportation and shipping insurance, and highly specific commercial liabilities.
So they turned their ability to manage complexity into a key market advantage.
They did, expanding coverage even while the political world around them was, in some ways, shrinking. This resilience, fueled by that underwriting expertise, propelled them into the next era of hyper-expansion.
Okay, let's move into that era. Section 2, expansion, financialization, and regulatory headwinds, covering the crucial years between 1979 and 2007. This is defined by AIG's transformation from a complex insurer to a globally interconnected financial conglomerate.
And this is where they laid the fatal groundwork for 2008.
Hmm.
The 1980s saw AIG actively pushing the boundaries of what insurance even meant. They became the go-to insurer for risks that others just wouldn't touch. We see the introduction of highly specialized offerings like pollution liability insurance and notably political risk insurance.
Covering clients against government seizure or instability in foreign markets.
Exactly.
These weren't your standard auto or home policies. These were massive, specialized contracts that required huge capital backing and intricate global knowledge.
And by listing its shares on the NYSE in 1984, they signaled their full entry into the capital markets.
That listing was essential, right? It provided the capital needed for true diversification beyond basic underwriting.
Absolutely. The 1990s saw AIG make acquisitions that took it far outside core insurance. The most prominent example has to be the purchase of International Lease Finance Corporation, or ILFC.
And they were one of the world's largest providers of leased aircraft to airlines globally.
Yes, a huge player.
That's a massive shift. I mean, leasing airplanes is fundamentally different from collecting premiums against a fire damage. What did ILFC do to AIG's balance sheet?
It injected vast amounts of non-traditional leveraged assets.
Yeah.
So instead of just insuring the risk of an airline losing a plane, AIG now owned the plane.
So they were assuming the capital risk and the revenue stream from the lease.
Right. And this added complexity, it added leverage, and it added a stream of income that was largely uncorrelated to the insurance cycle, which at the time was seen as genius diversification.
And during this period, AIG remembered its roots, making a landmark return to China in 1992.
That's a huge point. AIG received the first foreign insurance license granted by the Chinese government in over 40 years.
That wasn't just business. It was a potent symbol of global political influence.
A testament to Star's original vision, really. They were leveraging their unique history as an American company born in Shanghai to secure unparalleled market access.
Domestically, they targeted the burgeoning retirement market, acquiring Soon America Inc. in 1999, which was run by Eli Broad, diversifying into retirement savings and annuities. By the turn of the millennium, AIG was really touching every single aspect of finance.
Which leads us right into the peak of growth and scandal from 2000 to 2005. The first years of the new millennium were marked by massive acquisitions, like American General Corporation for life insurance and annuities, and aggressive entry into major emerging markets like India.
The sources also mention the company moving in the highest geopolitical and financial circles. I'm thinking of that strategic advisory venture they created in 2000 with the Blackstone Group and Kissinger Associates.
That level of interconnectedness is hard to overstate. This wasn't just some consulting agreement. AIG was an investor in Blackstone.
Right.
The advisory venture was designed to provide top-tier strategic counsel. But what's truly ironic, and it highlights the systemic links, is that Blackstone later became an advisor to AIG during the 2008 crisis.
So they were essentially consulting on the breakup of a company they had previously advised on growth.
Exactly.
And Greenberg himself was engaging in high-level diplomacy. We know he made significant investments in Russia in the early 2000s, including a personal meeting with Vladimir Putin in 2003.
Yes, to discuss strengthening U.S.-Russia economic ties and AIG's role in that. This was AIG at its absolute global political zenith.
But the hypergrowth contained these dangerous internal flaws. The first public cracks appeared in November 2004 when AIG settled with the SEC and the Justice Department for $126 million.
And that was related to the sale of so-called non-traditional insurance products, a euphemism for questionable financial engineering.
That was the warning shot. And then came the full regulatory barrage, which led to the ousting of the Titan himself, Hank Greenberg.
Greenberg was forced out in February 2005 amidst mounting fraud investigations led by the SEC, the Justice Department, and the New York Attorney General, Elliot Spitzer.
The scope of the scandal was enormous.
The subsequent NY Attorney General investigation resulted in a staggering $1.6 billion fine for AIG, one of the largest corporate fines at the time.
And the internal fallout was immense. What did the internal investigations uncover about the company's accounting?
The investigations revealed significant accounting errors, forcing AIG to restate financial statements for multiple years, specifically 2000 through 2004.
So this not only cost them billions in fines, but also severely eroded investor confidence in AIG's financial integrity.
Just before the housing market began its rapid descent, the company was structurally weak and politically damaged before the storm even hit.
And this brings us to the actual mechanism of failure. The single most destructive strategic mistake AIG ever made. The credit default swap trap from 2005 through 2008.
Yeah, this section has to be thoroughly dissected. It represents the profound failure in corporate governance that the FCIC later identified. In 2005, Martin Sullivan took over as CEO. Meanwhile, AIG's financial products division AIGFP in London, led by Joseph Cassano, was aggressively entering the over-the-counter derivatives market.
Okay, let's get technical for our audience here. We're not talking about simple car insurance. We're talking about credit default swaps, or CDSs, based on collateralized debt obligations, CDOs. How exactly was AIG involved, and what was the underlying bet?
AIG was acting as the protection seller in these agreements. A CDO is essentially a package of various mortgages, including many subprime ones. Banks that own these volatile CDOs, they wanted insurance against them defaulting. So they purchased CDSs from AIG and paid a periodic premium.
So AIG was betting that the underlying mortgages, even the subprime ones, would just continue to pay out indefinitely.
Precisely. They were insuring tens of billions of dollars of these derivative products. Their total exposure was $441 billion worth of complex securities that were originally rated AAA.
$441 billion.
And of that total, $57.8 billion were directly backed by subprime loans. AIGFP banked on the model, which suggested default risk was virtually zero.
But the fatal flaw wasn't just the bets they made. It was the internal systemic failure to manage the consequences of that bet.
That is the critical distinction. A core tenet of insurance and finance is hedging risk, or setting aside capital. AIG did not purchase reinsurance to hedge this enormous exposure. Furthermore, and this is the most critical point, AIGFP did not set aside significant capital reserves, nor did they require initial collateral from their trading partners for these swaps.
So they were operating a massive multi-hundred billion dollar exposure as a completely uncollateralized bet. Why would any major financial institution, especially one rooted in the discipline of insurance, allow that to happen?
It speaks volumes about the unchecked power of the financial products division and the lack of regulatory oversight on over-the-counter derivatives. AIGFP felt the risk was negligible because the underlying securities were nominally rated AAA. They just saw it as easy premium income with no capital requirement.
But the regulatory environment allowed this massive systemic risk to build up in the first place.
Absolutely. The sweeping deregulation of OTC derivatives, including CDS, meant that federal and state regulations, specifically those requiring capital and margin requirements that are common in traditional markets, were eliminated.
It created a loophole large enough for AIG to drive a multi-billion-dollar liability through.
You could say that.
And when the housing market finally crumbled in 2007 and 2008, the dominoes fell fast.
The drop in housing prices meant the value of the underlying subprime-backed CDOs plummeted. AIG's credit rating was subsequently downgraded, and the terms of the CDS contracts contained a tripwire.
What was the tripwire?
A credit downgrade automatically required AIG to post immediate, massive amounts of additional collateral to their counterparties.
But the company had zero liquidity to meet those demands.
None. And that effectively triggered a complete failure across the entire conglomerate. That unhedged, uncollateralized bet created a liquidity run that the traditional insurance operations simply couldn't withstand.
And that takes us directly to Section 3, the 2008 liquidity crisis and bailout. The failure of AIG wasn't a matter of if, but when, and how large the hole would be.
The instability was immediately reflected in the executive suite. CEO Sullivan resigned in June 2008, replaced by Robert Willemstad. But the crisis was moving faster than any internal management change could handle.
And the government ultimately mandated Willemstad's replacement with Ed Liddy on September 17, 2008.
Right. That signified that external control had already taken hold.
So the moment of truth arrived in September 2008. Why was AIG, more than almost any other institution, deemed too big to fail?
AIG's complexity and its global reach made it uniquely dangerous. Unlike Lehman Brothers, which failed the week before, AIG was interwoven with every major global firm. It was a primary trading partner to nearly 100 institutions
Including the giants of Wall Street, Goldman Sachs, Morgan Stanley, Bank of America.
and a vast network of massive European banks.
So if AIG went under, those CDS contracts would instantly default, triggering enormous losses across the entire global banking system.
Exactly. A September 2008 CNN Money article highlighted the terrifying scale. AIG possessed over $1 trillion in assets. That's far surpassing the size and complexity of Lehman. Its failure wouldn't just cause panic, it would seize up the plumbing of global finance.
This systemic threat, not necessarily AIG itself, is what the government chose to save.
That's the key.
So on September 16, 2008, the intervention began. The New York Fed authorized the secured credit facility.
The largest government bailout in history. The initial commitment was $85 billion, and the terms were deliberately punitive
Punitive how?
to protect the taxpayer and discourage moral hazard. The facility was secured by stock in AIG-owned subsidiaries. And critically, the government received warrants for a 79.9% equity stake in the company.
That 79.9% stake meant the U.S. government effectively owned and controlled the corporation, at least temporarily.
It was a temporary nationalization by necessity. Former Treasury Secretary Henry Paulson later testified that the terms were intentionally harsh. It was a rescue, but one that came with a near-total loss of corporate autonomy for existing shareholders.
Let's delve deeper into the forensic analysis of failure. The official post-mortem reports were blunt about who was responsible.
The 2011 report from the Financial Crisis Inquiry Commission, the FCIC, laid the blame squarely on AIG itself. Their conclusion was that the failure stemmed primarily from the mass sales of those unhedged insurance policies, the CDSs, without setting aside the required collateral, capital reserves, or hedging the exposure.
The FCIC famously concluded that AIG suffered a profound failure in corporate governance. What does that mean in practical terms?
It means the management, especially CEO Martin Sullivan and the board, failed in their fundamental duty to manage risk. The AIGFP division in London was allowed to operate as a completely opaque, unsupervised black box,
Creating liabilities that were exponentially larger than the traditional regulated insurance units.
They were essentially operating outside the risk protocols that governed the rest of the $1 trillion corporation.
But that internal failure was enabled by a regulatory void?
Precisely. Other analyses underscore the regulatory dimension. AIG was only able to build that systemic mountain of uncollateralized risk because of the sweeping deregulation of over-the-counter derivatives. If regulations had required even a small fraction of margin or capital reserves on those CDS contracts, AIG would have hit a capital wall long before the exposure reached catastrophic levels.
And this brings us to the most visceral moment of public anger, the bonus outrage.
Oh, yeah. The public cynicism that stained the recovery effort. This unfolded in March 2009, just months after the initial bailout. AIG announced it would pay executives over $165 million in guaranteed retention bonuses.
And the total potential bonuses for the financial products unit, the very group that caused the meltdown, could have reached $450 million.
A staggering figure.
How could a company kept alive solely by taxpayer funds justify paying retention bonuses to the very traders who destroyed the firm?
It was a monumental public relations disaster. The company argued that the bonuses were contractually obligated and necessary to retain the few key people they needed to help unwind the complex derivative portfolio.
They claimed that losing those employees would cost the government even more in the long run.
Is the argument they made.
An argument that did not sit well with the public or with politicians.
Not at all. Newly inaugurated President Obama and legislators from both sides of the aisle reacted with immediate outrage. Senator Chuck Grassley famously suggested AIG executives should resign or commit suicide.
A reflection of the extreme public anger.
Yes. The controversy reinforced this public perception that Wall Street was operating with a culture of entitlement and impunity, using taxpayer funds to reward reckless behavior. This episode defined the public narrative for years and solidified AIG as a symbol of corporate greed.
We shift now to Section 4. De-risking, recovery, and legal battles from 2008 to 2016. The government's plan was simple. Use the 79.9% stake to force AIG to shrink dramatically and liquidate assets to pay down the debt.
The massive asset divestiture was a forced dismantling of the global empire that C.V. Starr and Hank Greenberg had built over decades. And AIG had to sell these assets, often quickly, into a distressed market environment.
So what were the crown jewels they were forced to sell first?
The primary focus was on the most successful international life insurance segments, which were largely independent of the CDS disaster.
Right.
AIG created and transferred two massive international life subsidiaries, American International Assurance Company, or AIA, and American Life Insurance Company, AIG, to the Federal Reserve Bank of New York.
And that transfer alone shaved $25 billion off AIG's debt.
A huge chunk.
And these weren't small peripheral assets. AIA in Asia was a market leader.
AIA was the jewel in AIG's Asian crown. AIG was sold to MetLife for $15.5 billion in cash and stock in March 2010. Even more remarkably, the combination of the IPO of AIA and the sale of AIG raised a combined $36.71 billion in November 2010.
So these sales, executed under duress, were absolutely vital to generating the cash needed to exit the government facility.
And they also sold their Taiwanese unit, Nan Shan Life, in 2011.
What else went on the chopping block to raise capital?
The divestiture was thorough. It touched almost every non-core asset. They sold the Hartford steam boiler unit to Munich Re for $742 million. The domestic auto insurer, 21st Century Insurance, went to Farmers Insurance Group for $1.9 billion.
They sold a majority stake in reinsurer Transatlantic Re.
And their asset management business, PineBridge Investments, was sold for $500 million. It was a complete reversal of the diversification strategy of the 1990s.
This painful, years-long liquidation process eventually led to the crucial milestone: full repayment and sci-fi status removal.
The government made good on its promise to exit. The U.S. Treasury gradually sold its stock back into the market. By September 2012, the Treasury stake was reduced substantially to 15.9%.
A sign that AIG was stabilizing and market confidence was returning.
Exactly.
And the final payment was made in December 2012. Let's just confirm those numbers one more time because they're crucial to the historical narrative.
On December 14, 2012, the Treasury sold its final shares of AIG stock. The total amount provided to AIG, including all commitments, was $182.3 billion.
And the total repaid by AIG
was $205 billion.
Which generated a confirmed profit of $22.7 billion for the U.S. Treasury and the New York Fed.
That outcome fundamentally altered the legacy of the bailout program.
The company immediately sought to control the narrative post-repayment.
Yes. AIG launched the Thank You America advertising campaign on January 1, 2013. The ads featured employees, including the recovery-era CEO Robert Benmosche, directly thanking the American people for their assistance.
A necessary, calculated move to shift the public image from ungrateful recipient of bailouts back toward successful American institution.
It was. And the ultimate sign that AIG was no longer considered a systemic threat arrived in 2017.
That's when the U.S. Financial Stability Oversight Council, or FSOC, removed AIG from its list of non-bank systemically important financial institutions, SIFIs.
Right. And that SIFI designation was critical because it required the firm to adhere to much stricter regulation, higher capital buffers, stress tests, deeper oversight from the Fed.
So shedding SIFI status was a huge regulatory win. It confirmed that AIG had successfully de-risked and downsized to a point where its failure would no longer threaten the global financial system.
It was the formal government acknowledgement that the restructuring had worked, and the firm was fundamentally safer than it had been in 2008.
Yet even with that successful financial outcome, the legality of the initial government action was challenged in court. This brings us to the bailout litigation, Starr v. United States.
This is a fascinating legal challenge, specifically because of the paradox it created. Hank Greenberg, through his associated companies, sued the U.S. government in 2011 for $40 billion.
$40 billion.
He argued the terms of the bailout were illegal, specifically that the government denied AIG access to better loan terms offered to other institutions and illegally demanded the 80% equity stake. He called it a government extortion rate.
The trial was a highly public affair, pitting a corporate icon against the government officials who saved the economy. We saw testimony from Ben Bernanke, Timothy Geithner, Henry Paulson.
And Paulson's testimony confirmed the punitive intent of the terms. Government lawyers, meanwhile, were aggressive. They referred to the plaintiffs, the shareholders, as ingrates who felt entitled to a cheap bailout.
It was a deeply emotional case reflecting the scars of the crisis.
Absolutely.
And the ruling from Judge Thomas Wheeler delivered an extraordinary legal paradox.
Judge Wheeler actually sided with Greenberg on the core legal principle. He ruled that the government's demand for the 79.9% equity stake, which effectively nationalized the company, was an illegal exaction.
An illegal exaction.
Yes, the judge concluded that the Federal Reserve Act did not authorize the New York Fed to take ownership of a private corporation by demanding its stock.
An illegal act by the government, yet zero compensation was awarded. That's a tough loss for Greenberg. Why did the judge rule against damages?
Because of judicial pragmatism. The judge ruled that the plaintiffs suffered no economic damage because they were saved from utter financial ruin.
Right.
The judge's reasoning was summed up in a powerful statement. If the government had done nothing, the shareholders would have been left with 100% of nothing.
So the illegal act was simultaneously the act that preserved some value for the shareholders.
That's the paradox. And the ultimate resolution of the case solidified that pragmatic outcome. Greenberg's subsequent appeal was dismissed because the court ruled that the right to challenge the specific terms of the bailout belonged to the corporation, AIG, not the individual shareholders.
And AIG's board, having recovered the company, had already opted not to sue.
Exactly. The economic reality saving the financial system and profiting the taxpayer trumped the legal defect of the nationalization mechanism.
We turn now to Section 5, the modern era and restructuring, from 2017 to 2024. This phase is characterized by a focus on core insurance competency and radical structural simplification.
The modern turnaround officially began in 2017 with the hiring of Brian Duperreault as CEO. This was a significant hire because Duperreault was a true AIG veteran. He'd worked there from 1973 to 1994.
So the message was clear. AIG was returning to its insurance roots and bringing back leadership focused on underwriting expertise.
And Duperreault was fighting internal pressure immediately. Activist investors, especially Carl Icahn, had been loudly demanding that AIG be broken up into smaller, more digestible units.
But Duperreault resisted that pressure.
He did. Instead of dismantling the company, he pledged to grow AIG by stabilizing the core general insurance business while maintaining its multi-line structure. His team, including Peter Zaffino, who was hired as COO in 2017, implemented a major turnaround strategy.
Focused on underwriting discipline, stringent new risk guidelines, and a complete overhaul of reinsurance strategy.
And this focus on fundamental competence quickly paid dividends.
How so?
The structural changes were visible. They reorganized the legacy segments into clear, manageable units of general insurance and life and retirement. And the success of the new risk approach was validated in 2019 when AIG reported its second consecutive quarter of underwriting profits.
A milestone that demonstrated the core business was sound again.
It really was.
They also made smart, targeted acquisitions, which contrasts sharply with the scattergun approach of the 1990s.
Right. In 2018, they acquired Validus Holdings, which brought in much-needed reinsurance capacity, expertise in the Lloyd's of London syndicate, and a crop insurance platform. They also acquired Ellipse, a UK life insurance business.
And concurrently, they initiated the AIG 200 program,
which was an extensive, multi-year internal effort to modernize and digitize workflows and shed the complex, costly legacy processes accumulated over decades.
A key part of managing risk is dealing with past liabilities, the runoff portfolios.
That was the strategic purpose of Fortitude Re. Established in 2018, it was designed to hold those legacy runoff portfolios that AIG wanted off its balance sheet.
Oh.
AIG sold a majority stake in Fortitude Re in 2019 to Carlyle-managed funds and T&D Holdings.
So they effectively isolated and de-risked the remaining old liabilities.
Precise.
The ultimate structural simplification, however, was the Corebridge spinoff. This was the final step in permanently separating the company's risk profiles.
This was the culmination of that decade-long de-risking effort. AIG decided to spin off its life and retirement business into a separate, independent public entity, Corebridge Financial. The goal was to separate the volatile, capital-intensive general insurance business from the steadier, fee-driven annuity and retirement operations.
And Blackstone returned to the scene, but this time purely as a major financial partner to Corebridge.
That's right. The Blackstone Group acquired a 9.9% stake in the new Corebridge unit for $2.2 billion cash. Furthermore, Blackstone secured a long-term asset management agreement for about a quarter of Corebridge's portfolio,
providing Corebridge with instant capital and validating its financial strength.
Exactly. And the Corebridge Financial IPO in 2022 was the largest U.S. IPO of the year, raising $1.68 billion.
And AIG continues to streamline, focusing intensely on its core competency as the leading commercial and industrial insurer.
The divestitures continue. They sold crop risk services and significantly sold the bulk of their reinsurance arm, Validus Re, to Renaissancier for nearly $3 billion. They also sold the UK arm of AIG Life Ltd. To Aviva in 2024. These moves all underline the core strategy: maximum operational efficiency, minimum ancillary risk.
So AIG is back to being a focused, highly specialized insurer.
Right. And it remains the largest underwriter of commercial and industrial insurance in the United States.
Finally, we can't ignore how AIG has managed its image through global sponsorships. That's a key indicator of its brand recovery and confidence.
For sure. During the peak of the Greenberg era, they were famously the shirt sponsor for Manchester United from 2006 to 2010.
Right.
Following the crisis, as they rebuilt their image, they sponsored the iconic New Zealand rugby teams, including the All Blacks, starting in 2012.
But their current long-term sponsorship commitment is perhaps the most strategic in terms of image.
AIG is the title sponsor of the AIG Women's Open Golf Tournament, a commitment extended through 2030. They significantly increased the total purse, reaching $9 million in 2023, setting new prize money benchmarks in women's major championship golf.
So this associates the brand not just with global athletic excellence, but with promoting equity and growth in women's sports. A powerful statement of corporate image repair.
A very powerful statement.
So what does this all mean for the informed listener? Let's recap the narrative arc we've unpacked today. We started with the global audacity of Cornelius Vanderstar founding an American power in Shanghai.
Then Hank Greenberg's era of expansion and tightening control.
To the devastating systemic failure caused by selling $441 billion in unhedged credit default swaps.
The story is a masterclass in global financial risk management and the catastrophic consequences of ignoring it. The internal cultural failure, allowing the AIG Financial Products Division to operate as a rogue, uncollateralized black box, nearly brought the world economy to its knees.
The learner's takeaway here focuses on two powerful historical outcomes. First, AIG's successful recovery highlights the effectiveness of painful, targeted asset divestiture coupled with ruthless operational discipline.
And second, the story provides an astonishing example of governmental crisis intervention, where the taxpayer ultimately generated a $22.7 billion profit.
That positive financial return is essential context when judging the crisis actions, and it brings us directly back to the legal paradox raised in the Starr litigation. AIG successfully shed its systemically important status and spun off its retirement arm.
Right.
So here is the final provocative thought we leave you with, one that builds on the details of the sources but asks you to look ahead. Considering AIG made the government a profit, does the legal conclusion of Starr v. United States that the government's 79.9% equity grab was an illegal exaction, fundamentally flawed under the Federal Reserve Act, even if it caused no damages? Does that change how we should view the operational rules for government bailouts for critical institutions?
I mean, if the mechanism used to seize control and enforce the necessary de-risking was legally defective, but the practical result saved the global economy, how vulnerable are other globally interconnected firms if they face a similar liquidity crisis today? Has the law truly caught up with the reality of too big to fail, or will future interventions also have to rely on questionable legal maneuvering simply because the outcome justifies the means?
That's the challenge AIG's complex history leaves on the table. Food for thought indeed. Thank you for joining us for the deep dive.